I've heard that interest rates have come down over the last little bit. I know that recently the Fed lowered rates, and I know that there's talk about the Fed. Just so that you know, right now we are going into the fourth quarter of the year of 2025, and so it's projected that the Fed is going to continue to cut rates, most likely at least 2 more times by the end of the year is what's projected. So let's just jump into that just briefly. We don't have to get into a lot of details what that means, but let's just touch bases on that a little bit.
Okay, so that's a very good question. And for whatever season we're in, whatever year, I mean, really, if you ever hear that the Fed is going to lower the rates, this is going to apply to whatever that looks like. So when the Fed lowers rates, they're lowering the Fed fund rate, which is really around adjustable rates. And so great news for you as a consumer, how this affects you is your credit card bills that have those really high interest rates, those will come down a little bit. I mean, credit card rates are high anyway, right? But that'll come down a little bit. If you have a home equity line of credit, that's adjustable, that'll come down a little bit. It doesn't directly affect mortgage. The way it works with mortgage is mortgage will anticipate that they're going to be lowered. And all of the rumors about like, oh, are they going to lower it 0.25%, 0.5%? Well, mortgage will adjust itself based off of like these kind of predictions and theories. And statistically, the day of the lowering, the mortgage rates actually go up. And they did that this last September. The day of the lowering, the rates went up. So it's like, it's also emotional and temperamental. And if the Fed chair says something wrong or looks at somebody wrong, or like, it's just how much energy he has in making the announcement, it will affect the way the mortgage or the bonds really like going forward for the next move. So they kind of went up and then they came back down. So, and by up and down, it's like, you know, a month ago, rates were 0.5% higher than they are now. So, you know, 1/4 to 0.5% higher. So it's...
Okay, so let's talk about it. So rates are down about 0.5 point. So what does that mean for someone that may have bought a home in the past couple of years where rates were quite a bit higher?
Yeah, so there's been different waves in, you know, interest rates change just like the stock market does every day. You wake up and what are rates today? And they can change during the day too. So if you bought a house within, I would say the last 2-3 years, if your rate is above 6.5%, it would be worth looking into what a refinance looks like. Now, I can guarantee you that you are getting a ton of spam calls and a ton of emails and a ton of spam mail about lowering your interest rate. And a lot of the times, these guys are tricksters. They'll make it look like the letter is from your lender. And it'll say in really fine print, blank home mortgage isn't associated with so-and-so. And so, but like nobody sees that. They just see this like, you know, this glimmering beautiful interest rate and all this money they're going to save. And it always will say, and you may have access to this much cash. And there's all this little tiny fine print. And in that tiny fine print will say what's called an APR. And that APR is totally confusing and doesn't make sense to anybody except for some big like decision makers in the government. But the APR will show a rate that is higher than that like big glowing one on the letter. And it's basically a roundabout and confusing way to say that it's going to cost you a lot of money. So could you get that rate? Yeah, you could totally get that rate. Is it going to cost you $17,000? Probably. It probably is. So, and the other thing is a lot of times, like I had a client get a letter and send it to me, and I read the fine print, and it was like, this is the rate. This is what you can get out in cash. I looked up the value. It wasn't worth what the letter was saying that it was worth, so they couldn't get that. And it was saying in the fine print, this is a loan for veterans. So like my client had gotten an advertisement for somebody to do a VA loan, and she's not a veteran. So she wasn't even eligible for it anyway. So it's just like, We don't answer a phone number we don't know, right? A lot of us, we just won't answer. If we don't know the number, we're not going to answer it. Well, same thing with the mail. Like, it's still spam. It's junk mail. So I would never suggest responding to one of them because they're just phishing.
So what do you suggest somebody do now that rates have come down?
Yeah, I would call your loan officer that helped you with your purchase in the first place, assuming that you like them. If you didn't like them, then get a referral from somebody that you know or another real estate agent, somebody like that. I'm licensed in California and Utah, so I'm happy to help along those lines. And if you're in a different state and you're like, Liz, do you know somebody? Like, I know people all over. So let me, I'm happy to even just give you a referral. But what I would do is reach out to your loan officer and then talk to them about, can I refinance? Does this even make sense? A lot of people want to refinance and save money every month. That's really important to them. They want their house payment to be lower. We all want our house payment to be lower. I think personally, the way that I've ran my business for the past 8 years, and I know that you have done that for years too, because you've been doing this longer than me, is we do what's called a no point, no fee refinance, meaning we're not charging extra for interest rates, and we're not charging for the closing costs. Now, what that means is people are getting paid. The appraiser wants to get paid. The title, the escrow, everybody wants to get paid, but what is happening is we're getting a credit from the lender based off of your interest rate, and we're using that credit to pay for the closing costs. It's like a gift card. Interest rates this is how interest rates work. They come at a cost or a credit. So the higher the interest rate, the more credit you're going to get for that interest rate. Credit meaning like a gift card. The lower the interest rate, the more it costs you. It's like when you buy a nice car and there's like that base LX model, and then as you go up to like the EX or the Sport or whatever, and like the rims get nicer and the speaker package and leather seats, like all of those things, it gets more expensive, right? So same thing with interest rates. Like, the better the interest rate, the more the savings, the more it's going to cost you.
Okay, so Liz, when you talk about a no point, no fee loan, you're getting a credit from the lender to cover the cost of the refinance.
Right.
Now, that doesn't mean that they aren't going to have some costs associated with the loan, because no matter whether or not they refinance or not, they still have to pay their interest on their loan. If property taxes are due or insurance is due, no matter what, those are fixed costs that aren't necessarily associated with the refinance, but they still have to be paid. Right. But when you say a no point, no fee loan, what you're referring to is paying the costs that are associated with the refinance. So that would be like the appraisal fee, if there's title and escrow fees.
Yeah, underwriter,
those types of fees, you can get a credit from the lender and cover those costs. Interest, you got to pay that no matter what.
Right.
Taxes, you got to pay that no matter what. Insurance, you're still obligated to make that. So those fees are fixed and you're obligated to pay them no matter what, whether you refinance or not. But the actual cost of the refinance, you can get a credit from the lender to cover those costs.
Right, yeah. And so as far as refinancing goes, if you're under, like, cost of refinancing, if you're under, I would say $600,000-ish, your cost to refi is probably $4,000. If you're above $600,000, it might be like $5,000. This is the strategy I usually use, and because I like a good deal, and I like things that are free, and or like really low cost. And so I feel like we're in an environment where interest rates are going to be coming down over the next few years, and we're just kind of at the beginning of this wave.
I would agree. I do think that rates are going to come down over the next couple of years. I just think that with the way that the market is going, the economy is going, I think that rates are going to come down over the next little bit. How much they come down, I don't know, but I do think that we certainly are on that tipping point where rates shot up super, super fast over the last couple of years, and now we're seeing indications in the economy and in the market where things are tipping the other direction.
Yeah, and rates never just drop. Like, they don't come down fast. They usually will just sort of float down.
Well, the interesting thing is rates will shoot up really, really quick,
Yeah.
but they drag and come down so slow.
Yeah, that's true. So, for me, I am, like I said, we've done this for years. So you can refinance after 6 months. You should be in your loan for 6 months. And there's a whole backstory to that, but that's not important right now. You should be in your loan for 6 months. We can reevaluate your loan after 6 months. So if we could, the other cool thing that we can do is we don't have to start your loan over at 30 years, because we know that like a mortgage is front loaded with the interest. So when you make your payment each month, a little tiny bit goes to pay off the loan and the rest goes to the lender. So if we continue to go back to 30 years, you're going to be paying the bank a lot of money. But we can do a 29-year loan, 28, 27. So we don't have to take you off track of what you're doing. And then we lower the interest rate. So my goal really is to, if we can lower it for 1/4% and we can get the lender to pay for it, so it's free, like the refinance part is free. We don't start your term over. You just are saving an extra 1/4% long term on your loan. That's a ton of money. We're not taking you off track. Like you're it's just, to me, it's like this no-brainer. Now, could you pay extra for a lower rate? Yeah, you totally could. If you wanted to pay the $4,000 or $5,000 in closing costs to get the lower rate and save more money every month, you could do that. But could we also probably get you to that lower rate without you paying for it over time?
Well, and here's the interesting thing. You might pay several thousands of dollars, and if we're in a down market and rates are coming down, you may never recoup that cost of that refinance.
Yeah. And there's a
meaning what I mean by that is that you might get to a point where the interest rates are lower than what you refinanced at, paying points and fees.
Right.
And so you're just out that money.
Right. Yeah. You don't get that money back.
Because you're not going to get it back, and you can get a lower interest rate.
Mm-hmm.
And so if you refinance, you literally are just out that money.
Right. Yeah. So
I mean, that's where we get into like our belief in, I mean, I've been doing this for over 20 years now. I mean, you've kind of been on that journey with me for the 20 years. I mean, we started having kids and you kind of took a step back while they were kind of, in their toddler years and stuff, and you jump back in, 6-7 years very, ago, hot and heavy. But we've always been of that mindset of taking advantage of that credit from the lender to do a no fee loan, and then just ride the market down.
Right. Yeah. And like I have clients who are just really set on like, no, we want to wait, which is fine. We'll respect what you want to do. We're not going to like talk you into it or make you do it. But they want to wait to get it lower and lower. But like in the meantime, they're wasting so much money. Like, why not just do this for free? We're not starting your loan over. We're lowering your rate for free. And like, just sometimes like there's just, but no, we were told to not lower it unless it's 1%. Okay, that's true if you're going to
pay for it, for sure. But if you can get the bank to pay for it, like it really is, it's a no-brainer. You should take advantage of that every single time.
Yeah. And the even better, there's like 2 reasons why you want to refinance. One, you want a lower house payment, and your payment's too high, you stretched yourself too much, and you need a lower house payment. In that case, we may go back to a 30-year because the goal isn't this like big long picture savings, but like that monthly savings. Or the second strategy would be, I want to pay the bank less money. And so what we do, we just are closing a file tomorrow, it'll fund. They are lowering 1/4%. We got enough money to pay for all of their closing costs. And they're going to pretend like they did not do a refinance. They're just going to keep paying the same payment they've always been paying. So instead of that, I think they're saving like $90 a month, which I actually think is a lot. Like $90, that's a tank of gas, right now. And if they keep making that payment, I think we did the calculation, like, I think they'll pay their house off in 24 years instead of 29 years. Like, that's significant.
So let's just do some math here. I want to do some math. So, because I kind of geek out on some of this stuff, like when we talk about no point, no fee loans, because I think this is really cool. So I'm just going to, like, let's just pretend like 12 months ago you did a purchase for somebody. Let's just say that their loan was $624,000. So $624,000. Let's just say the interest rate was 7.125. The reason why I'm doing this is because I just went back through some more files, and this is kind of the scenario. So we've got a loan of $624,000. It's a 30-year loan. The interest rate is 7.125. 624,000. 30 years. 7.125. So the payment on that is $4,204. Now let's just say that they've been in that loan for 12 months. So they've paid down 12 months of payment. So now their loan is now $617,812 over 12 months because they've been making their payment. So let's just say that we put them in a 29-year loan. And their payment now on a 29-year loan at $617,812. And let's say we can lower their payment by, let's just say we drop down to 6.875. So 6.875. Their new payment is $4,101 and some change. We'll just
saves them $100 a month.
So basically, it's saving them $100, right?
Yeah.
So they're
staying on track.
So they're on track. They save,
and they got that loan for free.
They didn't pay anything for the loan.
Right.
Now let's just do the math and just say, okay, they're comfortable making that $4,204 every month. So let's just say they're going to continue the $4,204 payment. So if they keep making their original payment, they will pay that loan off in 323 months, saving them 25 months in payment.
Okay, so then you do.
So now so for 25 months they've shaved off 25 months of payment, and let's just say they no longer they were obligated to make a payment of $4,101. So they are no longer obligated to make that $4,101 payment for the next 25 months. They've saved that. So 25 months times $4,101. What do you think that is? $102,525.
Yeah, wow. So doing this free loan, even if rates don't come down anymore, and we just did this loan and they kept making their same payment, saved them $100,000
over the life of the loan.
Over the life of the loan. Yeah, that's bananas. Yeah, so that's the power in it. Of course, I think you're going to always get the argument of like, well, if they just paid for it, they could save even more and it would catch up over time and all of this stuff. And sure, there are lots of strategies around refinancing. And do I think that this is the last refinance we'll do for these guys? No, I think that rates will continue to come down and we'll continue to be able to get them lower rates, and they will continue to make their same house payment as they are now, and they're going to pay their house off.
Yeah, and you'll take advantage
sooner than the 25 months.
And you'll take advantage of each time. Like they don't have to go into a 30-year loan. You could put them in a 29, 28, 27-year loan.
Right.
And as the market comes down, they just take advantage of that no point, no fee loan. And I mean, they will just shave off months and months and months of their mortgage payment over time.
Right. So to me, it's such a no-brainer, but I'll tell you, if you're wondering, should I pay for the refinance? Because maybe there's a point at which you're like, maybe this is the end. This is the lowest they're going to go, and I just want to pay and never have to refinance ever again. We just do the math on it. Like, what's the break even? So if the break even on a refinance and then paying extra for a lower interest rate is $10,000, how long does it take you in your savings to get to $10,000? Because after that, it's all gravy, right? So you just have to decide, like, okay, if it takes 5 years to break even on that savings, but this is your forever home, you're going to be here the rest of your life, then maybe it would be worth it.
But I think you also have to ask yourself, do you think that rates over that next 5 years are going to come down lower than what you actually refinance
Yeah,
for?
I think we're in an environment where I would not suggest paying extra for the interest rate. I just wouldn't. I think there's circumstances where like this one thing is really critical and we don't care what the cost is because we need it to be here. Sure, then that's a totally different circumstance. But if it's just like, we actually are fine with our payment, we're just trying to help you with strategies to pay your house off faster, then let's do that.
So what other advice, suggestions do you have for people that, we're in this market right now where refinances really have not been on the radar unless it was needs driven for the past probably 2-3 years.
Right.
And now we're getting back into the market where, refinances are going to become, a more normal part
something that's just available to people.
It's definitely going to become more of the norm.
Yeah. I would contact a lender that you trust. I would not go with some like online lender who is making a lot of promises. A lot of times those online lenders they're not even licensed. They're just sort of like order takers. So they don't even know if your information's correct. We have one right now, actually, this is a purchase actually, but the taxes are totally wrong. If the online lender doesn't know that, they're not going to catch it because they're just like, they might be located in a totally different state for one thing, but also they just don't care. Like this is kind of their gig before they find another gig kind of a job. And like, I definitely had a cousin that worked as like at one of these online lenders. And I think that, do you like going to the DMV? Like, can you imagine going to the DMV to get a mortgage? Like, that sounds terrible. And so I just think that's the same kind of circumstance. So I would suggest talking to like a loan officer that you trust, that you connect with. If you can find them, through their social media, like with us, I think that's great. You find somebody that gives you a lot of value and education. I do think that is super important. Yeah, I think that's mainly what I would say. The things that you're going to have to anticipate to come in with this credit, it's covering costs of the loan, title, escrow, underwriting, appraisal, different kinds of loan costs. But if you have an impound account, and this is really important, that doesn't roll over to your new lender. Like you'll get it refunded to you, but it won't roll over to the new lender. So you have to front the money for that. So that can be done in a couple of ways. You can like pull it out of your checking account to pay for it. And then when you get the refund from your old lender, reimburse yourself or increase the loan amount to cover the setup a little bit. And then when you make your first payment, you get that refund from your old lender, take that first payment, just pay it down to the new lender. So you're not increasing your loan. So you'll have that, and then you'll always skip a month of a house payment. And what I mean by that is you don't like technically skip a house payment, but you are paying some prepaid interest. So like if you close in October, your first payment wouldn't be probably until December. So that's just like, you just know you'll skip the next house payment. So there's some savings there too.
Can you explain that a little bit more? Because I don't think people understand how interest is collected. Because when you make your December 1st payment, you're not paying interest from December to January 1. You're actually paying interest on November.
The interest behind you. Yeah. So
November
you pay
to December.
Right. So you pay interest. It's called in arrears. So you always pay interest for the month behind you. So like I was saying, if you close your loan in October, let's just say October 15th. Well, we've already gone halfway into the month for the loan with the old lender. And now we're going the last half of the month into the loan with the new lender. So who's going to get paid? Well, the old lender is going to get paid through the payoff demand. And then the new lender will get paid through what's called prepaid interest. So you're going to pay the new lender ahead of time the last 15 days of the month. So you don't need to make a November house payment, right? Remember, November is going to pay for October because the old lender will be paid off in the payoff. The new lender will have the prepaid interest. So October is taken care of. Your first payment's in December because it's going to pay for all of that interest that happened in November. So that's just how it's confusing. I understand.
The bank is always going to get their interest.
They will always get their money, honey.
So it is. It's always funny when I hear, you get to skip a payment. Like,
kind of.
You don't really get to skip a payment.
Yeah.
You're just.
It's an interest only payment if that makes a difference.
You are still paying interest.
Yeah.
No matter what. So.
Right. Yeah. So I think that I love our strategy. We've been doing it for years. I don't know. It makes a lot of sense to me. All of our clients, it doesn't hurt you to refinance. It doesn't hurt your credit. You still have to qualify every time. So that is important to know that just because you have a mortgage now doesn't mean that you don't have to worry about refinancing, qualifying. Like, you still have to qualify. But I would say, like, most of our clients, we probably have refinanced them 5 or 6 times. Like, that wouldn't be an uncommon, how much we've had. And we've gotten them, like, actually, I would say 90% of our database we've refinanced into, like, the COVID rates. And when we did get to that, like, experience, most people did pay extra for the lower rate because it was like, there's no way this is ever going lower. Yeah, right?
I mean, I kind of wish we would have paid to get down to like 1.99.
I know. Yeah, that's true.
I mean, we did have a client that did do that.
Yeah, we did, because he was like, this is where I'll be forever, and the payback was like 5 years.
But it totally made sense. Like, I mean, the likelihood, I mean, the chances of it going much lower than 1.99, like never. Like, yeah. And so, like, I will say that is probably the one time in our career that I kind of regret. And to be honest, I mean, the interest rate that we've got on our house is phenomenal. Like, it's incredible.
Right, yeah. It's not like tons higher than that. Yeah.
So it's not substantially higher, but like, if there was the one time I would have thought like we should have paid, it was then.
Right.
Like, getting down to 1.99 would have been pretty sweet.
Yeah.
But
I think we have to remember, like, people really wish that the interest rates would come down to that again, and it makes such a big relief on our budgets, right? But the thing you have to remember or think about is, like, what was going on in our world that those were the interest rates? Like, that time sucked, and chances are you didn't even have a job, or you knew people that didn't have jobs or weren't working enough hours, or it was just like a mess. And then if you were trying to buy a house, it was super competitive, and rates, like, I think people got into houses like just because they like impulse buy, had to make a quick decision that they regret getting into because of just the pressure and it making house prices go up, and houses were going 100,000 over asking, like just stupid stuff, So I feel like the market that we're in now is so much more like sustainable and manageable, and it allows you to shop a little bit more and find the place that suits you, and just know that the price is of the house now is what you're locked into. The loan, we always can change.
So I do have this question to ask. I know that, like, over the past couple years, I mean, the housing market has kind of been stagnant, and in some areas has actually kind of retracted a little bit. So how does that affect somebody going into refinancing?
Yeah, that's a really good question, because we've definitely ran into it. Like, the loan we're closing tomorrow, actually their house appraised for less than they paid for it. So it'll be a year. They haven't even actually been in their house a year yet. And it came in, I want to say $20,000 less than they paid for it, which is like sucky, but it'll come back. Fortunately for them, they had put enough money into it that it didn't make a big difference for their loan. They still had 20% equity. It wasn't a big deal. But if you got into a house with like a 3% down payment, or maybe even 3.5%, 5%, and the values have come down a little bit, you may not be eligible to refinance. So
are there any situations where the appraisal doesn't matter?
if you have an FHA or a VA loan, then they have something called a streamline refinance, and I don't think they consider the value. So that's good. So it could save you there. But yeah, if you got into a conventional loan and the rates have changed, it could change things. So,
but on a streamlined FHA or VA loan, they just kind of are looking at whether or not this is a benefit to the borrower. And if it's a benefit to the borrower, then they will allow you to make that adjustment.
Yeah. And what determines the benefit is at least 0.5% lower. So you can't, this strategy doesn't work as well with like a 0.25% step, but if you can do a 0.5% step. And then my other thing is, like, both of those government loans have additional closing costs that can get financed. And my credit that I want to try to get is also going to cover that cost. So it's not just the $4,000 refinance cost. It's going to try and cover the additional government closing cost.
Awesome.
Yeah.
So I think that, this is like you said originally, this has kind of been our strategy throughout our career in helping people save money and get a better interest rate. And we just kind of step them down as the market continues to come down with interest rates.
Yeah, we're just riding a wave. We're really into surfing, so.
Surfing can be a lot of fun.
I'm sure it can. It looks fun. I don't want to do it, but.
Thanks so much for watching. If you are interested in refinancing, please reach out, shoot us a text, or give us a call. You can book a 15-minute appointment with Liz, and she'd be happy to go over the numbers and let you know exactly what will work for you and what you can do. Again, thanks so much for watching, and we'll see you in the next video.